Good morning. This is Dan Frio, the rate update. I, of course, am Dan Frio. What we're going to talk about next is it's Federal Reserve Week. What does that mean? Unfortunately, the way the markets look so far this week, it doesn't look good. So don't go away. We're going to talk about that next. Sorry, guys, I got a brand new desk. It goes up and down and sideways and everything else. Pretty cool. But I'm still getting used to it because I still lean and the thing jiggles. So my apologies about that. So what we're going to talk about today is Federal Reserve Week. So what the economic data is for the week, what I think the Federal Reserve is going to talk about. The biggest thing is inflation and jobs. That's their mandate. So before we do that, I have Ella Lyrian. He's a Wall Street analyst economist, and I'm going to let him talk and say his spiel. And then we're going to jump in afterwards, and I'm going to put my 2 cents in behind all this so you guys understand what the markets should do this week. So don't go away.
Why is the 10-year yield reacting this way? Why does the 30-year look like this?
So last week was very technical in nature, and the CFTC data confirmed that. People got caught offside. They were long equity. They were short bonds. You had the double shock to that trade, first the Omicron variant, and then you had Chair Powell's surprise announcement. And that does caught people offside. And what we've seen is a massive repositioning of a crowded trade. So last week was technical, but more generally, I would encourage you every day to look at the yield curve, not the level of yields, but the yield curve. And that is starting to signal more concern about a policy mistake, which is the Fed not going fast enough in the beginning and then having to overdo it later on. So that's why you're seeing these curves flatten with the 2-10s now down to 76 basis points.
So that's what you think the message is from the markets these days? I mean, that's pretty complicated, that they're not going to move quickly enough, but then they'll have to do a whole lot to catch up, and that's going to hurt the economy pretty extremely?
Yes, and that's the worry, okay? And that inflation has become, as I've said to you in the last few weeks, the major threat to the markets. That the Fed simply has underestimated the inflation threat. It has stuck to the transitory call for too long. And now it is exiting that call, but it's doing it late. And it's doing this in the face of 2 other developments, which is a new COVID variant and what's happening in China. So that's why the market is starting to sense this notion that we are going to have a policy mistake that will add in the short term to the stagflationary winds, and in the long term may well cause the risk of a recession.
If you look at commodities prices, lots of commodities, but let's just take oil as an example, it has come down precipitously. I mean, it's dropped for the last 6 weeks in a row and is now below $70 a barrel. 68.07 is where we're sitting this morning, so barely above 68. If you're looking for inflation in places like that, it's not there. I guess what you're talking about is the bigger concern that this works its way into wages, and maybe that's exacerbated by a new variant that keeps some people not wanting to go back to work. Is that what you're talking about when it comes to this?
You're absolutely right. If you look at inflation cycles in the past, and I want to stress, we're not going back to the 70s, but we're going to something that neither the economy nor the markets are wired for, which is inflation that persists above 4% for a while. We may even get a 6.7, 6.8, 6.9% print later this week. So this is serious inflationary pressures. What tends to happen in a typical cycle is you have an initial dislocation, commodities being one, it could be something else, but an initial dislocation that is not taken seriously and then starts changing behaviors. And the 2 behaviors it changes are wage earners behaviors and price setters behaviors. And we have a lot of evidence that these behaviors are changing on the ground.
Okay, so the way he makes it sound, it's not good news. Well, I hate to say, but there's more to that story than we want to really know. So let's see, how far now will Powell's new hawkish tilt go? Here's what investors will be looking for in the Fed meetings. So basically what we're looking for is how much are they going to taper? How much, how fast, and what the expectations of rate hikes are for 2022. Remember not too long ago, they said, oh, the Fed isn't going to do anything until 2023. And I jumped all over that. And I said, there is no way they're going to wait till 2023. I'm still trying to find those videos because I said it probably 50 times. I've been doing this way too long. And I know if you extend out a prediction 2-3 years, that's too far out, especially when I saw what's going on with mortgage rates and the economy and so forth. So here's the analogy behind this all. So we were in dire straits. So let me kind of make sense of all this for you. This is my intake, and it's playing out like a fiddle on all this stuff. Yes, I'm from West Virginia originally, so I know what a fiddle is. All right, so let's get to it. The economy was doing very well, okay? And then we had political change, then we had COVID, then we had all of this other stuff happen. So what happens is the Federal Reserve and the government comes in and pushes down rates and makes it easier on consumers, home buyers, home builders, home owners, the economy. Okay, so that's the first thing. So they dropped down rates, made it more easy to get mortgages, to get credit, to get lending. Okay, so that's done. A lot of people lost their jobs. So the federal government came in and stepped in and said, okay, we're going to give out unemployment. We're going to give it to gig workers. So they did that. People flushed in their accounts and everything kind of went on. My kids still don't have to make a student loan payment until next month. So they haven't had to make a student loan payment in a year. A lot of people haven't had to make a mortgage payment if they have a house for the last year. So if you didn't have a house payment and a student loan payment, how much money would you free up in a month? Okay, so that's that. So now you have the wage pressure behind everything. And I talk to companies from manufacturers to sales to logistics to every piece of this puzzle I've talked to, and they're like, dude, we're offering benefits. We're offering this. We're offering high-end salaries. People aren't coming back to work. I still can't put a beat in on. I'm going to put a survey down below or create it on the website to say, what's your thoughts on all this? I'd love to hear why you think people aren't going back to work. Please put that down below because it's got me baffled. So people do have a lot of money in their accounts. Most people do. People are getting money for their kids. $300 now, I think, is the new stimulus piece of the equation. Eventually, this stuff's going to catch up. So if you're going to get frustrated on inflation, how much money did you take from all these stimulus packages? And that money needs paid back. Okay, so that's the first thing you want to think about. The supply chain issues. Yes, there is supply chain issues. Why? A lot of shortages. Okay, a lot of labor shortages. Labor shortages is creating this whole thing. So my thought, think this through. If you lost your job or you were getting paid more than you were used to and you put money aside and so forth and you're like, okay, now it's November, December, there's millions of jobs out there. Last week's JOLT index said there's 11 million job openings. There's 2 million people out of jobs. So there's plenty of job openings. Then people will say, well, it's not the wages I need or I deserve. Sometimes you might have to step into the job market and get a job to get back into the swing of things. So eventually people have to go back to work. Okay, that's all there is to it. When? I don't know. When they do, the dust will begin to settle. Okay, so now every time there's another virus that peeks its ugly head, now we have some people that are afraid to go back to work. Or they have little kids. They don't want to put their little kids into school, so they have to stay home to watch their kids. It's a vicious cycle. But when this settles down, I still feel that we're going to come back to as normal as we can. Okay, everybody's like, well, housing. Think of gas. How much do you spend in gas? $50 a week, maybe? Okay, so let's see if gas doubled. Okay, gas doubled, which it could. They're predicting oil to go to $120 a barrel. It's $60 a barrel now, so it could double. So now you have your $50 gas bill each week go to $100. Well, that would increase your gas usage by $50 a week, so $200 a month. Well, if you remember, I did an analysis. If you bought a $250,000 home, and if rates went from 3 to 4.5, you'd increase your payments by $200 a month. It's kind of the same with your gasoline. So don't freak out about the housing market. Yes, there's a supply demand. It will eventually stabilize. But I promise you, it's going to happen. When? I'm not talking decades from now. I'm talking in the next first quarter of 2022. And we'll come back to this video. I'm going to tag it so I can show you guys if I was right or wrong. And if I'm wrong, I'll play it again and say, dude, I was wrong. I was completely wrong on that. So now, without further ado, let's get on to rates because that's why you're here. So let's scan over to where did rates open for the day and where did they end on Friday. So let's go through this. I'm going to make this as simple as I can for you. We're going to go to the 30-year rates. They're right here. Today they opened at 3.2, down 1 basis points. The 15-year was at 2.54, down 1 basis points. The FHA was 2.88, down 2 basis points. So let me explain this, what I'm doing, guys. I'm going right across this top line, 30-year YRFRM. That's the 30-year fixed rate. Today, 3.2. Yesterday, 3.21. That means it dropped by 0.01. That is on the change section. We referenced the 0.01 is 1 basis point. And you can go down through. We can still see the 5-year ARM is still higher than the 30-year fixed. So please don't look into trying to get an ARM because you can get a lower fixed rate if that's your goal to do that. How's the market reacting to all this? Well, it's acting pretty good. I think a lot of this is baked in. I think there's going to be a little bit of a rally coming through. I'm predicting the MBS market to be right through here at 102.4. So we have about 29 points to go. That's a pretty big move, but I'm still going to stick by that. Why well, there's a lot of reasons why, and I'll go over that in another video. So what we monitor here is what's going on with the MBS market. And you can see that right up in this area here, okay? The MBS, what is that? Mortgage-backed securities. It's a bond that trades on Wall Street that is the biggest component or the factor in your mortgage rate. It is not the S&P 500. It is not the 10-year Treasury. Okay, so then let's scroll down. Here's the trend for the last quarter. What might seem like a complete yo-yo, but if you look at this, let's look at the lines here, and let me crank that in right here. Is you could see that if you go across here, let's just go into the last quarter. Well, let's go through here. That's about where we should be. I'm going to put that line across there. All right. And that's almost where I'm expecting us to be. I think we should rally up to about this point right here. Okay. And again, so let me piece this together. As this number goes down, like it does through here, that means rates are going up. This is what's happening to the price of a mortgage-backed bond. So the price goes down, yields or mortgage rates go up. And conversely, the other way, if this goes up, rates are coming down. Okay, so that's the last quarter of what's going on. Well, let's look at the economic news for this week. And there's really nothing today. There is nothing today. But tomorrow you can see a lot of the inflation numbers are coming out. And these are the numbers that the Fed watches. They watch the PPI, the Producer Price Index. It comes out month over month, the change, month over month, and they strip out food and energy. Why? Because those are really volatile, and they turn on on a dime. They'll move up and down really quick. You can see, drive to work and the gas prices are one price, drive home and it's another price. So that's why they strip those out. And then the year over the year and the year over year. And then on Wednesday, we'll have Federal Chairman Powell, the Federal Reserve will come out with their decision and tell us what they decided to do. And Federal Chairman Powell come out at 1:30 and speak to Congress. That can be a wham bam of a day that day because we have more import prices and things coming in on that day. Then the following day, the numbers are looking at jobless claims, continued and initial. Then housing starts and everything. So it is one full week other than today. So tomorrow I will be posting early again. I apologize, I'm late this morning with rates today, but I'll post tomorrow morning and then I'll be posting another rate update tomorrow afternoon, letting you guys know what I think the Fed's going to do, and we'll drill it down more and more and more in detail. So guys, if you're looking for a mortgage, what I'd like to ask you to do, if you're in need of a mortgage, know somebody, friends, family, neighbors, relatives, or whatever, please give us a shot. We're licensed in 30 states over the country. The one major state that we get a lot of business from that we can't do yet is New York. So if you're looking for some assistance, if you're looking to build a house, buy a house, refinance a house, get a cash out refinance, renovate a home, anything of that sort, please reach out to us. The best way to do that is what you'll do is you'll go to therateupdate.com. You're going to skip it over, click it over there. I'm going to scroll down here. And let me shrink down a little bit because I'm standing right now. I just got a brand new desk. Multiple ways you can get a hold of us. The best way we ask people to do is give us a call, 844-775-5626. That's the number one way we want you to call. Not for hard pressure sales, but your situation is unique. what are you looking to do? What's your credit scores? Where you work? Where you been? How long you been there? So forth. Everybody's story is a little bit different. The next way to do it is book a meeting. This is another way you can do it face-to-face if you want to. We can do it by Zoom. So you can call us, do face-by-face, or if you're like, Dan, I just need some help. Just get this done for me. I'd really appreciate what you guys are doing. Just click the Apply Now button, and you're on your way. As soon as you finish your Apply Now button, probably within the hour, I can almost assure you there's going to be a mortgage advisor on the phone with you, answer any and all questions that you have, lock in, and get the mortgage rolling. So that's it for today, guys. All I ask you to do is please give me a thumbs up, subscribe down below, hit the bell every time I post a video. You get an alert. It helps me find more clients and more people to educate like yourself. So thanks again for watching. I'll see you tomorrow. Bye-bye.